Are the government's inflation numbers a lie? And what does this mean for our treasuries? Hello, Diamond NestEgg members, Super Savers, and course fans. I hope you're healthy and well. And I also hope that those of you with kids or grandkids who are now back at school had a good start to the new school year. In New York, school doesn't typically start until after Labor Day, so our kids are still enjoying the last lazy days of summer. Who may not be enjoying these summer days so much recently is the Bureau of Labor Statistics, the BLS, after President Trump fired its commissioner, Erica McIntyre, following the release of a less than favorable jobs report. And some of you in our community also appear to be concerned about this and what this may mean for your treasuries. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Are rate cuts coming? And in this section, we'll also talk about how markets interpreted this week's CPI, the Consumer Price Index, and PPI, the Producer Price Index. And maybe even more importantly, whether we can still trust any of the inflation numbers that come out of the BLS, what this may mean for our TIPS, our Treasury Inflation-Protected Securities, and I-bonds, as well as what the alternatives are if an investor doesn't really want to rely on them going forward. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Are rate cuts coming? The latest CPIU numbers that were released this Tuesday show that overall prices in the U.S. rose by 2.7% year over year. Core inflation, which excludes more volatile food and energy prices, increased a bit more by 3.1%. These were not stellar readings, but they came in basically as expected, and the market sentiment was that inflation is still higher than the Federal Reserve would like, but not high enough to stop the central bank from cutting interest rates next month. But then PPI, the Producer Price Index, was released a few days later, showing a year-over-year increase of 3.3%, the highest since February. Now, prices for services have been rising faster than for goods for the entire last 12 months. So despite some headlines, the data does not tell us that tariffs were driving the price increases. That said, more expensive services could potentially reflect higher labor costs as a result of less illegal immigration. But it's impossible to tell from these numbers directly. What we do know, though, is that CPI typically does lag behind PPI, so the next few months' inflation data should be interesting. The markets wavered a bit for a day or two, and then decided to shrug off any concerns. Equities hit new record highs this week, and so did Bitcoin. Plus, the CME Fed Watch tool continues to predict a probability of more than 80% for a rate cut by 25 basis points at the next FOMC meeting in September. This would bring the Fed funds rate down to between 4 and 4.25%, from between 4.25% and 4.5% currently. And to remind the long-term investors in our Diamond NestEgg community, cuts to the Fed funds rate, which is for overnight money, do not always mean lower long-term rates as well. In fact, the latest Reuters survey of bond strategists essentially takes the opposite view and predicts that longer-term U.S. Treasury yields will rise modestly in coming months on tariff inflation worries and a deluge of new debt issuance, even as short-term yields fall on renewed Federal Reserve rate cut bets. So, for those of you who still haven't joined our bond courses, there's no better time than now. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or Bond Masters individually. In any case, it was more or less business as usual this week. Some data came in, the market interpreted that data to see what it might mean, and then changed its opinion again and again as new data came in. As we often say at Diamond NestEgg, and as we all know, no one can predict the future. But we should at least be able to rely on the data that tells us what happened in the past, such as the numbers that the Bureau of Labor Statistics, the BLS, pulls together for us every month. But Exactly this trust was shaken a bit when President Trump fired Erica McIntyre from her position as head of the BLS after some bad employment numbers were released, as we mentioned earlier. President Trump claimed it was not because he didn't like the numbers per se, but rather he wants to have more accurate, less volatile, and less politicized employment data. This ruffled more than a few feathers in the market and the media, as we can see from this Wall Street Journal headline. What happens when politicians meddle with economic data? Argentina's example. And this is really the critical question, as the BLS publishes not only the employment numbers, but even more importantly for our Diamond NestEgg community, it also publishes the CPI, the Consumer Price Index, and the PPI, the Producer Price Index. The CPI directly impacts the lives and investments of many Americans, including the yield for TIPS, Treasury Inflation-Protected Securities, and I-bonds, as well as the cost of living adjustments for Social Security, many government pension schemes, and most inflation index contracts in the private sector, such as for some rents and wages. Now, we can't look into the president's head to see what his motivations are, but what we can do is what we always do at Diamond NestEgg and look at the data to see whether the employment data from the BLS have really become more volatile and less reliable in the recent past. And because the topic can be highly emotional, as so many discussions are these days in our country, let's have a look at an unsuspecting source, the British Broadcasting Corporation, or BBC. So, the BBC looked at total U.S. job growth revisions for 2-month periods for the past 45 years, since records began in 1979, and found that last week's 258,000 combined reduction total for the 2-month period represents the biggest change since records began, aside from the months in 2020 following the outbreak of the COVID pandemic. In the bigger picture, something seems to have changed after COVID. During the last 30 years, large downward revisions used to happen only around real economic and financial crises, such as here around the great financial crisis of 2008-2009, and then again around COVID. However, these seem to have become much more frequent recently. Now, before the political commentary starts, do note that all these large downward revisions more recently don't necessarily need to come from undue political bias. The BBC quotes Catherine Abraham, previous BLS commissioner from 1993 to 2001, saying she was not surprised to see such large revisions for May and June, given increased difficulty of collecting responses and lack of investment in new methods. It seems that for their first estimates, BLS employees are still to a large degree making actual old-fashioned phone calls to ask firms about their employment numbers. And with people picking up their phones less and less often, it may be no wonder that large revisions have become more commonplace recently. Just out of curiosity, would you pick up the phone if you saw that the BLS was calling you at work? Drop a comment below because I'd really like to know. In any case, it seems the BLS, irrespective of the political environment, would benefit from speeding up its adjustment to the digital age a bit, and maybe that would make the initial estimates less prone to large revisions. And one might potentially be able to make a case for shaking up the leadership of the BLS to help with the transitions. So President Trump has already sent his nomination for the next Commissioner of Labor Statistics to the Senate for confirmation. Irwin John E.J. Anthony comes from outside the BLS and is described as a conservative think tank economist to stick with the BBC as a source. But some media reports are much less flattering. Where does that leave us with the critical question of whether you can still trust the CPI numbers? Well, it now all depends on whether the Senate will confirm Anthony, and if he gets confirmed, what his initiatives will be at the BLS. Will he focus on speeding up new approaches to collecting even more accurate data in the digital age? Or might he be tempted to try to put his finger on the scale, so to speak? Only time will tell, but we will watch the developments carefully here at Diamond NestEgg, given how important inflation numbers and inflation-adjusted bonds, such as TIPS and I-bonds, are for many in our community, us included. In the meantime, we haven't changed our investment strategy personally and continue to hang onto both our TIPS and I-bonds, at least for now, and until it all becomes clearer. It's rarely a good idea to rush into decisions or even panic when it's about your long-term investments. But of course, we will keep our eyes and ears open as we always do. That said, everyone's financial journey is different. If you are concerned about the reliability of the CPI, then the question becomes, what else could you do to inflation-proof your portfolio if you don't want to rely on tips and I-bonds? The sobering answer here is that your options are limited in bond land. There aren't really that many private sector bonds out there that are indexed to inflation to start with. You could potentially have a look at annuities with inflation protection, annuities with a cost of living adjustment rider, as the industry says. But this will only work if you can find one that is tracking a different index than the CPI, which I have not. There are some more indirect routes as well to inflation-proof a bond portfolio, but they are complicated and carry their own risks. So for example, if you expect the US dollar to devalue against other countries with a historically strong track record of low inflation, you might consider bonds denominated in Swiss francs or Singapore dollars, but then you bring currency risk into the picture, and that is also unpredictable. Plus, even a low inflation rate may not prevent a steep currency depreciation, as we've seen with the fall of the Japanese yen over the past few years. So your best option for inflation-proofing a portfolio, if you're losing trust in the BLS and the CPI, is probably to go for real assets such as stocks, real estate, and maybe gold and other precious metals and commodities, or even Bitcoin or other digital assets, if you're open to them. Now, for those of you who are staying put with your treasuries, let's move on now to the next section of today's video. Which treasuries rose the most and which ones fell this past week? Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Similar to last week, all yields 2-year and below were stable or slightly down, while all yields 3-year and beyond were up a bit. At the extreme ends, the 30-year now pays 44 basis points more than the 1 month. And while this may be not that much of a premium in the historical view, it's still 7 basis points more than last week. As the market says, the yield curve is steepening, which also reminds us that long-term yields may go up even when short-term yields go down, as we already mentioned earlier in the first section of this video. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The picture is a bit less clear here. The yields at the very extremes of the range are all up a bit and even inching closer to 5% again at the long end. But everything in the middle is still down, and especially the 1-year, 2-year, 3-year, and 5-year, which all remain stuck below 4% for the time being. Now, we're not exactly sure what to make of this dip in the middle, but maybe it's just that no one really knows where this might all go, and so investors buy more medium maturities to keep their options open. And this extra demand could keep the yields down. If you have any theories or insights of your own, drop a comment below and let me and the community know. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, and that it looks like the market may be anticipating lower rates as soon as September, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. The 20-year T-bond and the 30-year TIPS are also on the schedule. The 30-year TIPS auction is a reopening auction, so we already know what the coupon will be on that. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 20-year T-bond auction. And here's what the coupon and the expected yield are for the 30-year TIPS auction. And as a point of reference, this expected yield is higher than the current fixed rate on an I bond, and it's also at one of the highest levels in over 15 years. So if you're comfortable with tips, this may be something to take a closer look at. Bond beginners, folks, please refer back to these two modules here on tips and I bonds for a refresher. The break-even inflation rate on the 30-year tips was 2.27% at the close of market on Friday. And as we mentioned earlier, the latest BLS inflation report showed annual inflation coming in at 2.7% overall and core inflation coming in at 3.1%. So if the 30-year tips fits your timeline, goals, and expectations, and you want to add some inflation protection to your portfolio because you believe that inflation over the next 30 years will average more than 2.27% annually, then this may be an option to consider dollar cost averaging into. We're pondering this one at the moment ourselves for a personal portfolio. So please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to take advantage of the current attractive bond rates before they come down potentially, then check out this video here on our bond courses. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase bond beginners or bond masters individually. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.